High interest rates are making many of us give up on our dreams of home ownership. But here's the secret that the pessimists don't want you to know. There are ways you can buy a home, even if you would normally get a high interest rate, without breaking the bank. Listen up, it's time you learn what they won't tell you and become a homeowner. The first and best thing you can do to purchase a home with high interest rates is to buy a smaller home first. If you go a bit smaller than you had hoped for on the first house, you can then build equity with that investment and then use that to buy a larger home in about 5 years. What is equity? Equity is the difference between what your home is worth and what you owe your lender. Let's say you purchase a house for $300,000. Your mortgage is 30-year fixed with a 7.5% interest rate. Not including taxes or insurance, let's keep it simple for now, your monthly payments toward the principal and interest would be $2,098 a month. If you pay every month, after 3 years, you would still owe $287,582 for the house to your lender. But if we assume the yearly average appreciation of 4.58% on the house, which is the average for the last 30 years, in 3 years, the value of your home will be $343,136. That means the asset you own, aka your house, is worth $55,554 more than you owe the bank. We call that having $55K in equity. It's part of your net worth because the house is yours, although you still owe the bank part of it. So how does that equity help you buy a new house? After only 3 years, you now have equity to put toward a down payment for your next house. If you sell this house, you can use the sale amount to pay off the first loan, and after you subtract real estate agent costs, which are usually about 6% plus seller closing costs at 1%, totaling 7%, you will have $31,535.28 to use toward your next home. That's after only 3 years. What would you have if you waited 5 years? After 5 years, your balance on the mortgage would be $279,833. Your home's value would be about $375,288. That gives you $95,455 in equity. Subtract the 7% in agents' costs and seller closing costs, and you will have $69,184.53 to use toward your next home. This is just one example. Making extra payments or larger payments will help you pay the home down quicker and give you more equity to use toward your next home. Buying a smaller home first can help you afford the home of your dreams down the line, but there are other strategies to get better financing, lower down payments, and more. In all of these cases, your ability to repay is the lender's main concern, so try to make good financial choices leading up to your home purchase. This also means that many of the programs allow you to prove your ability to pay through down payment, not credit history. For most of these programs, we're looking at a credit score minimum of 620. Though some will go down to 500 and some require at least 700. But in all cases, a better credit score will help. Let's start with the government-backed programs. First time buying a house? You may qualify for the First Time Home Buyer program from the Department of Housing and Urban Development, or HUD. If you have not owned a property within the last 3 years, you may qualify with the 3% Home Ready and Home Possible loans. You may need enough for a 3% down payment, and you need to be making less than the Area Medium Income (AMI) in your area. One perk of this program is that they require lower mortgage insurance than a conventional loan. Additionally, they usually have a lower rate because you won't get a hiked up rate for being a risky borrower. Similar to this 3% HUD loan, the FHA offers a 3.5% down loan. The FHA is the Federal Housing Administration, which is also part of HUD. It requires an upfront mortgage insurance premium, but this is a loan available to those with a credit score of at least 580, who often get huge interest rates from conventional loans. The US Department of Agriculture, USDA, offers 100% financing for loans in certain rural areas. These loans require no money down, but your income can't exceed 115% of median household income. If you're interested in this loan, check out the USDA's eligibility site. It will tell you what areas are eligible for the loan. Are you currently a veteran? Veterans qualify for 100% financing through the VA. These loans have better rates than conventional loans and use residual income rather than credit score or down payment to qualify. What is residual income? The money you have after you've taken care of ongoing monthly expenses. This is often money you would use for investment, savings, or things like a vacation fund. The VA uses this amount to determine if they can reasonably expect you to pay back the home loan. Besides government-provided home loans, you can also go for non-traditional loan types. You could get a piggyback loan. Instead of financing your home purchase with a single mortgage, you take out two. What's the difference between these two loans? One is smaller, the piggy on the back. The second loan will give you funds towards your down payment so you can pay more of the bigger loan up front and get a lower interest rate. Often, you take 80% out for the initial mortgage and then 15% of the home value is covered by the second mortgage. And you only pay 5% down. That's why these can also be called 80-15-5 loans. This can be a great option because you can borrow a higher amount with a lower interest and no mortgage insurance. If you have enough for 20 to 30% down for an investment property, you can get a DSCR loan. DSCR stands for Debt Service Coverage Ratio. The benefit of this loan is that they do not use your current income to qualify. Instead, an appraiser calculates expected rental income for the property. If it's enough to cover the mortgage, you are able to take out the loan. You typically can't use this kind of loan for a primary residence, since it has to be for an income-generating property. Are you a doctor? You can qualify for your own special kind of loan. For doctors, student loan debt can be excluded from debt ratios. This will help you get a better adjusted interest rate. These require no PMI, though you will need to set up an auto payment from your bank account to reassure the lender. These loans also have a maximum amount of $1 million with a max loan-to-value ratio of 95%. That means you can purchase a home costing at most $1,052,632. If you're hoping to purchase a home in the $200,000 and under range, you could qualify for a 1% down payment program. You also need to have an income that's below 80% of AMI. These loans can be great because they don't require a credit score. Instead, they look at non-traditional proof of credit, such as whether you make your utility payments on time. As an added bonus, often the lender gifts 2% of the loan, up to $4,000. This type of loan was developed to allow more buyers to enter the housing market, even if they don't have a ton of credit history or savings for a down payment. You could also consider a temporary buy-down. This kind of mortgage program reduces the home buyer's monthly payments in the first year, and sometimes in the first 2 or 3 years. In a temporary buy-down, you will pay a lump sum to reduce your interest rate. You can also do a temporary buy-down where you pay a lower down payment now in exchange for paying a larger sum later. Different states often offer special grant and loan programs. Check your state for what may be available. If you're in California, you could qualify for the California Dream DPA loan. DPA stands for Down Payment Assistance. These help you purchase or refinance a primary residence in California. You need a 640 credit score or higher, which is higher than many down payment loans. But this loan can help you with closing costs and help you get a lower interest rate in the long run. In Hawaii, the Hula Mai mortgage program will actually give you 3% towards your house. Not a loan, a gift. Funds are limited, so this won't be around for long. If you're purchasing in Hawaii or know someone who is, act now. Loan programs change regularly, so check with lenders in your area for special options you may qualify for. If you're struggling to improve your credit score or save up for a home, who's the culprit? You'd be surprised. Learn about the #1 wealth killer in this video.